Hi guys, this is Mark McRae, and today we're going to be looking at some more financial ratios. And as I've always tried to do, I'm trying to encourage you to become more financially literate. I'm not an expert, I'm not an accountant, but over the years I've kind of educated myself with some of the things that I think are important in business. And each business is unique and different. So you might, for example, build a dashboard that is very heavy on, the things that are interesting to you, and someone else might have other things that are interesting to them. There is no perfect dashboard. There is no perfect numbers that you should look at. They should be the numbers that are important to you. So let's have a look at a couple today. We've got return on equity. This is a very important number for investors, right? So if you're trying to raise money, you're trying to, judge one company with another company, if you're going to buy companies, this is a very important number. So this ratio measures the return generated by a company's equity and is calculated by dividing the net income by the total equity. It provides insight into a company's ability to generate profits from the investments made by its shareholders, and is typically measured on a yearly basis. So if you took the net income of the company and divided that by the shareholders' equity, that would give you an idea of what kind of return you could have on your money. And you actually can have another ratio, which is return on cash, but let's just focus on return on equity just now. So if you had to invest $100,000 into a company and it gave you back at the end of the year $10,000, you would have a 10% return. So if you were looking at two different companies that you wanted to invest in, and one was giving you 25% return and another one was giving you 30 and one was giving you 15, it's a way of kind of measuring which one would potentially be a good investment. I say potentially because there's a lot of other factors there. So the debt to asset ratio, very important. And this is, if you invest in shares, this is a number you're going to look at a lot. So the debt to asset ratio is a financial ratio that measures the proportion of a company's assets that is financed through debt. It is calculated by dividing a company's total debt by its total assets, normally done on a kind of yearly basis. So if you had a look at all of your assets, imagine there was you had $1 million in assets and your liabilities were $270,000, then the debt to asset ratio would be 27%. Now, it's quite, in smaller companies, it is what you see most of the time. You don't want a high number. And I know I said previously, generally you are looking for a high number, but in smaller companies, you're not really looking for a high debt to asset ratio. But it can be used very well, particularly with bigger companies. Anyway, I hope these little tips and pointers are helping. The best place to get me is on YouTube. Just look for Mark McRae, and when you're there, if you like the information, subscribe, like, give me a thumbs up. Thanks for listening.